Welcome to our first video in our series on job costing. In this video, we are going to look at an overview of the accounting entries for a job costing system. For the remainder of the series, we will then do a deep dive into how we record our material costs, our labor costs, and our manufacturing overhead costs. We will also look at the completion of production and the sale of the finished good. Let us have a look at our learning objectives for this video. We will begin by asking ourselves what job costing is and why we need it. We will then consider the major elements of a job's cost. Next, we will have a high-level overview of how our costs flow through the accounting records. Finally, we will end off by briefly comparing the major types of accounting systems for inventory, namely integrated and interlocking accounts. We will also briefly explain the concept of control accounts and look at how accounting for just-in-time systems differs from that of traditional systems. When we refer to job costing, we first need to understand the concept of a job. A job is basically a unique item or a unique batch of output. Consider the two pictures on screen. In our first picture, we have cans of tinned food. Every can is going to be identical. Also, we are not only going to produce one batch of canned food, but we are going to mass produce this canned food. Therefore, we are not producing a single unique item or once-off unique batch of output. Therefore, this is not a job. If we look at our second picture of custom guitars, we see that each guitar is different and unique from the other guitars. While each guitar will have the same basic type of input, for example, wood, metal, etc., the quantity and quality of such input may differ between the different guitars. As such, custom guitars would qualify as a job and job costing would apply. Now that we know what a job is, we can see that job costing is a costing system that is required when each unit or batch of output is unique. As a result of this uniqueness, we need to accumulate the cost of each item on an individual basis. A job costing system therefore enables us to estimate the cost for a specific unique job and provide a quote to a customer, as well as determine the actual cost of sales for each individual job. What are the elements of a job's cost? As with other production processes, we have two broad cost classifications. First, we have our direct costs, which generally comprise our direct materials and our direct labor. Remember, these direct costs are those costs that can be directly traced to the item we are producing. Next, we have our indirect costs, which comprise our manufacturing overheads. Indirect costs are those costs that cannot be directly traced to the item we are producing. Also remember that we can break down our manufacturing overheads into a fixed and variable element. Let us have a look at an example of a job card. Now, the job card is the primary document for accumulating all our direct and indirect costs to the job. Notice some of the things we have here. First, we have some identification details that really help us to create an audit trail for our inventory. You will notice that we have a unique sequential job number. Being unique and sequential helps us to ensure that each job has been recorded. It is related to our completeness assertion in auditing. We also identify the job supervisor so that we have isolation of responsibility. The dates started and completed help us to ensure we record production in the correct financial period and relates to the cutoff assertion in auditing. Next, we have the detailed costing of the product. We have separate areas to record information for the direct materials, the direct labor, and the manufacturing overheads. Notice that when we add direct materials to the job card, we need to reference the amount added back to the source document, being the materials requisition, and we record the unique requisition number. Likewise, for direct labor, when we add an amount, we need to reference it back to the source document, being the time ticket or time sheet. This process of referencing back to the source document again builds up the audit trail. We will look at examples of these source documents throughout the course of the series. Then, for our manufacturing overheads, we need to record the quantity of the cost driver, which is in this case hours, and the associated rate. The final section of the job costs sheet is a cost summary, which summarizes the total cost for each element of the job's cost, as well as the total cost and per unit cost of the job. Now let us look at an overview of how our costs flow through our set of accounts. We will have a more detailed look at this when we look at each cost separately in our subsequent videos. We start off with our costs of direct materials, direct labor, and manufacturing overheads. Our direct materials are purchased from our suppliers and maintained in storage until they are needed for production. When production on our job begins, we requisition materials from storage and start to accumulate our labor and overhead costs. We record these costs in a work in progress account, which reflects the fact that our work is incomplete. Once the job is complete and no more costs will be accumulated, we transfer the job from work in progress to finished goods. Our job then stays in the finished goods until such time that it is sold to the customer. The cost of the job is then recognized as an expense through cost of sales. We then also need to record the revenue generated from the sale, as well as any non-manufacturing overheads, such as selling costs. What we can also see here is that the items in blue, being our material stores, work in progress, and finished goods, relate to inventory, which is an asset, and recorded in our statement of financial position. On the other hand, our sales, cost of sales, and non-manufacturing expenses relate to income and expenses, which we record in our statement of profit or loss. Now that we have seen the flow of costs through the accounts, we will consider our two broad cost accounting systems. First, we have an integrated set of accounts. Here, the costing and financial accounting systems are combined into one accounting system. Our cost accounting relates to matters around inventory recording and valuation, whereas our financial accounts relates to issues around fixed assets, debtors, creditors, and so forth. In an interlocking set of accounts, then, we keep the costing and financial accounting systems completely separate, often through the use of two unrelated softwares. They are then connected through the use of control accounts. Generally, an integrated set of accounts is preferred, as it removes the duplication of accounting entries and also makes the pulling of reports for planning, control, and decision-making easier. It is also important at this point to understand what a control account is. Essentially, a control account is simply a summary account in the general ledger. So items such as inventory, debtors, and creditors generally have control accounts, which represent the totals based on the underlying inventory, debtors, and creditors ledgers. So, in the inventory ledger, we would have details of each separate stock item, including how much of that item we purchased and how much we sold or issued to production for the period. The total value of this inventory ledger will then be summarized in our general ledger through an inventory control account. The final issue we will look at in this video is a brief overview of recording for a just-in-time inventory management system. Just-in-time, or JIT, is an inventory management philosophy which basically requires an item just as it is needed. So for example, if you require wood for production, the wood will arrive on the factory floor from the supplier immediately as you begin production. It is not kept in storage. This idea of JIT essentially aims to eliminate the need to hold inventory, thereby reducing the costs associated with inventory holdings. Because of this reduction in inventory, the valuation of inventory becomes less important, and we are able to simplify the accounting processes associated with inventory. These simplified accounting processes are known as backflush costing. In order to achieve backflush costing, various trigger points need to be identified to determine when the accounting entries are made. In its simplest form, there is only one trigger point, being the completion of the finished goods. Other trigger points, however, could include the purchase of the raw materials and any related components. This brings us to the end of our overview of job costing. In our next video, we will have a detailed look at the recording of direct materials. See you next time.